Here's Lesson 5, Support and Resistance, from Technical Analysis of the Financial Markets by John J. Murphy. Microphone Lesson 5, Support and Resistance. Hello friends. Welcome to Lesson 5 of Technical Analysis of the Financial Markets by John J. Murphy. In this lesson, we are going to learn about two of the most powerful and basic concepts in technical analysis. Support and resistance. These two levels help traders understand where prices stop, where they reverse, and how to find entry and exit points in the market. Direct Hit Part 1. What is support? Support is a price level where the buying pressure is strong enough to stop the price from falling further. In simple words, support acts like a floor under the price. Whenever the price falls and reaches this level, it tends to bounce back upward. Speaking head in silhouette, for example. If a stock keeps falling but every time it touches 100 rupees, it goes up again. Then 100 rupees becomes the support level. That's the point where buyers are ready to enter the market. Direct Hit Part 2. What is resistance? Speaking head in silhouette, now let's talk about resistance. Resistance is a price level where the selling pressure is strong enough to stop the price from rising further. It acts like a ceiling above the price. Whenever the price goes up and hits this level, it usually falls back down. Speaking head in silhouette, for example. If a stock rises but drops every time it reaches 150 rupees, then 150 rupees becomes the resistance level. That's the point where sellers come into the market. Direct Hit Part 3. The psychology behind support and resistance. Speaking head in silhouette. Support and resistance are not just about numbers. They are about human emotions. At support levels, traders believe the price is low or cheap, so they start buying. At resistance levels, traders feel the price is too high, so they start selling. This emotional reaction of fear and greed repeats again and again. And that's what creates strong support and resistance zones on the chart. Direct Hit Part 4. Role reversal, when support becomes resistance. Speaking head in silhouette, a very interesting thing happens in the market. Once a support level is broken, it often becomes a new resistance level. And once a resistance level is broken, it often becomes a new support level. Speaking head in silhouette, for example. If a stock breaks above 150 rupees, which was resistance before, and stays above it, then 150 rupees becomes its new support. This is called role reversal. And it's one of the most important principles in chart analysis. Direct Hit Part 5. Trend lines as support and resistance. Speaking head in silhouette, support and resistance are not always horizontal. They can also move with the trend. And that's where trend lines come in. In an uptrend, the trend line below the price acts as support. In a downtrend, the trend line above the price acts as resistance. These are known as dynamic levels, because they change with time as the trend continues. Direct Hit Part 6. Importance of volume. Speaking head in silhouette, volume plays a key role in confirming support and resistance. If prices bounce from support or fall from resistance on high volume, then that level is considered strong and reliable. Speaking head in silhouette, remember, the more times a level is tested without breaking, the stronger that level becomes. Direct Hit Part 7. Breakouts and false breakouts. Speaking head in silhouette, when price moves above resistance or below support, it's called a breakout. It signals the possibility of a new trend. However, not all breakouts are real. Sometimes, prices break a level and quickly return. This is called a false breakout or a fake move. Speaking head in silhouette, smart traders always wait for confirmation, like a retest of the level or a move with high volume, before entering a trade. Direct Hit Part 8. Lesson summary. Speaking head in silhouette. Let's summarize the key points of Lesson 5. White Heavy Mark support, a price level where prices stop falling and buyers step in. White Heavy Mark resistance, a price level where prices stop rising and sellers appear. White Heavy Mark. These levels represent market psychology, fear and greed. White Heavy Mark. When broken, support becomes resistance and resistance becomes support. White Heavy Mark. Trend lines also act as support and resistance. White Heavy Mark. Volume confirms the strength of these levels. White Heavy Mark. Breakouts signal the start of new trends, but watch out for false ones. Direct Hit Conclusion. Speaking head in silhouette, support and resistance are the foundation of technical analysis. They help traders see where buyers and sellers are likely to take action. When combined with trend lines, volume, and chart patterns, they become powerful tools for decision making. Always remember, white right pointing backhand index support shows where buying begins, and resistance shows where selling starts. In the next lesson, we'll learn about price patterns, like head and shoulders, triangles, and flags, which help us predict the next big market move. Here's the lesson 6, Price Patterns, summary from Technical Analysis of the Financial Markets by John J. Murphy. Microphone Lesson 6, Price Patterns, Script Format. Intro scene calm confident tone. Speaking head in silhouette. Hello friends. Welcome to Lesson 6 of Technical Analysis of the Financial Markets by John J. Murphy. In this lesson, we will explore one of the most powerful tools in chart reading. Price patterns. Price patterns help traders identify when a trend is continuing or reversing, and they give clues about the next possible market move. Let's begin. Direct hit part 1. What are price patterns? Speaking head in silhouette. Price patterns are specific formations on a chart created by the movement of price. They show the battle between buyers and sellers, and help predict which side is likely to win next. These patterns can be divided into two main types. 1. Keycap reversal patterns, which signal a change in trend direction, and 2. Keycap continuation patterns, which signal the trend will keep going. Chart with downward trend part 2. Reversal patterns. Speaking head in silhouette. Let's start with reversal patterns. They show when an existing trend, either up or down, is about to end or reverse. Here are the most common ones. White down pointing backhand index. A. Head and shoulders pattern. Speaking head in silhouette. This is one of the most famous reversal patterns. It usually forms at the top of an uptrend. It has three peaks: the left shoulder, the head, the highest point, and the right shoulder. The line connecting the lows of these peaks is called the neckline. When price breaks below the neckline, it signals a trend reversal. The market may start moving downward. Inverse head and shoulders. This is the opposite version. It forms at the bottom of a downtrend and signals that prices might start rising again. Large blue circle B, double top and double bottom. Speaking head in silhouette. These are simple yet powerful reversal patterns. A double top occurs when price reaches a high level twice, but fails to break it both times, signaling the end of an uptrend. A double bottom happens when price hits a low level twice and bounces up, signaling the end of a downtrend. Once the neckline, the middle level, is broken, the trend usually reverses direction. See triple tops and triple bottoms. Speaking head in silhouette. Similar to double tops and bottoms, but here, price tests the same level 3 times. These patterns confirm stronger resistance or support levels before the trend reverses. Chart with upward trend part 3. Continuation patterns. Speaking head in silhouette. Now let's look at continuation patterns. These patterns appear during a trend, when the market pauses or consolidates for a while, and then continues in the same direction. Here are the main ones. White down pointing backhand index. A. Triangles. Speaking head in silhouette. Triangles are among the most common continuation patterns. They show a period of indecision between buyers and sellers. There are 3 types of triangles. 1. Keycap ascending triangle, higher lows with a flat top usually bullish. 2. Keycap descending triangle, lower highs with a flat bottom usually bearish. 3. Keycap symmetrical triangle, both highs and lows converge. Breakout can go either way. When price breaks out of the triangle, it usually continues in that direction with strong momentum. B. Flags and pennants. Speaking head in silhouette. These are short-term continuation patterns. They appear after a sharp move, like a flagpole. A flag looks like a small rectangle slanting against the trend. A pennant looks like a small triangle. Both represent a short pause before the trend resumes. Example: if a stock jumps sharply upward, forms a small flag, and then breaks out, it usually means the uptrend will continue. See rectangles, trading ranges. Speaking head in silhouette. A rectangle forms when price moves between parallel support and resistance lines. It shows that the market is in a temporary pause. Neither buyers nor sellers are dominant. Once price breaks out of the rectangle, it often continues in that breakout direction. Direct hit part 4, the psychology behind patterns. Speaking head in silhouette. Every price pattern represents the psychology of traders. Their fear, greed, hope, and hesitation. When the pattern completes and price breaks out, it signals that one side, either buyers or sellers, has finally taken control. That's why successful traders always wait for a breakout before confirming the pattern. Direct hit part 5, volume confirmation. Speaking head in silhouette. Volume is an important factor in confirming patterns. During pattern formation, volume usually decreases, showing indecision. But when the breakout happens, volume should increase sharply, confirming that the move is real and strong. Direct hit part 6, measuring price targets. Speaking head in silhouette. Price patterns can also help traders estimate targets. The height or width of a pattern can be measured and projected from the breakout point to estimate how far the next move may go. Example: if a triangle is 20 rupee high, then after breakout, the price often moves another 20 rupees in that direction. Direct hit part 7, lesson summary. Speaking head in silhouette. Let's quickly recap what we learned in lesson 6. White heavy check mark price patterns show battles between buyers and sellers. White heavy check mark to main types, reversal and continuation. White heavy check mark head and shoulders, double tops bottoms reversal signs. White heavy check mark triangles, flags, and rectangles continuation signs. White heavy check mark volume confirms breakouts. White heavy check mark measuring the pattern helps estimate price targets. Direct hit conclusion. Speaking head in silhouette. Price patterns are like the language of the market. Each shape tells a story of emotion, pressure, and change. By learning to recognize these patterns, you can predict the next possible move in the market with greater confidence. Always remember, white right pointing backhand index patterns repeat because human behavior never changes. In the next lesson, we'll study volume and open interest to understand how they confirm price movements and strengthen trading signals. Here's the lesson 7, volume and open interest summary from Technical Analysis of the Financial Markets by John J. Murphy. Microphone lesson 7, volume and open interest, script format. Speaking head in silhouette. Hello friends. Welcome to lesson 7 of Technical Analysis of the Financial Markets by John J. Murphy. In the last lesson, we learned about price patterns, how the movement of prices forms patterns that tell us about the market's next possible direction. In this lesson, we'll focus on two very important supporting indicators: volume and open interest. Both of these help confirm whether a price move is strong or weak, and whether the trend is genuine or false. Let's begin. Direct hit part 1, understanding volume. Speaking head in silhouette. Volume simply means the total number of shares or contracts traded during a specific time period, such as a day, week, or month. It shows the level of activity in the market. When volume is high, it means there is strong participation. Many traders are active, and interest in the market is high. When volume is low, it means fewer traders are participating, and the move might not be strong or reliable. Chart with upward trend part 2, the role of volume in trend confirmation. Speaking head in silhouette. Volume helps us confirm trends. John Murphy emphasized a simple rule. White right pointing backhand index, volume should expand in the direction of the trend. Let's understand this with examples. In an uptrend, volume should increase as prices rise, showing strong buying interest. In a downtrend, volume should increase as prices fall, showing strong selling pressure. If volume shrinks while the price continues moving, it could be a warning that the trend is losing strength and may soon reverse. Bar chart part 3, volume in different market phases. Speaking head in silhouette, let's see how volume behaves in various stages of a market trend. 1. Key cap at the beginning of a new trend. Volume is usually low but starts to increase as more traders notice the move. 2. Key cap during the middle of the trend. Volume remains strong, confirming the health of the trend. 3 key cap at the end of a trend. Volume may suddenly spike as traders rush in. This often signals exhaustion and a possible reversal ahead. Chart with downward trend. Part 4. Volume and price relationship. Speaking head in silhouette. The relationship between price and volume tells us the quality of a move. Here are a few key principles. White down pointing backhand index. White heavy check mark, price up plus volume up is equal to bullish confirmation. White heavy check mark, price up plus volume down is equal to weak rally. White heavy check mark, price down plus volume up is equal to bearish confirmation. White heavy check mark, price down plus volume down is equal to weak decline. This combination helps traders understand whether a breakout or breakdown is trustworthy or false. Chart with upward trend. Part 5. Understanding open interest. Speaking head in silhouette. Now let's discuss open interest, which applies mainly to futures and options markets. Open interest, or OI, means the total number of outstanding contracts that are still open and active at the end of the trading day. If you buy one futures contract and someone sells it to you, open interest increases by 1. If either of you later closes the position, open interest decreases by 1. So, open interest shows how much new money is flowing into the market. Electric light bulb. Part 6. Using open interest with price. Speaking head in silhouette. Just like volume, open interest helps confirm the strength of a trend. Let's understand the combinations. Price action. Open interest action. Meaning, price plus OI. New money entering, trend is strong. Price plus OI. Short covering, trend may end soon. Price plus OI. New short positions, strong downtrend. Price plus OI. Long liquidation, trend may weaken. In simple words, open interest tells us whether fresh positions are being added or old ones are being closed. Direct hit. Part 7. Volume and open interest together. Speaking head in silhouette. Volume and open interest, when studied together, give a complete picture. Volume tells us how active the market is today. Open interest tells us how much commitment there is in the market overall. If both are rising along with price, it confirms that new money is supporting the trend. A strong bullish sign. If both are falling, it means traders are losing interest, and a trend change could be near. Left pointing magnifying glass. Part 8. Divergences. Speaking head in silhouette. Sometimes, we see a divergence between price and volume or open interest. That means the two are moving in opposite directions. For example, if price is making new highs, but volume is not increasing, it's a warning signal that the rally may be weak. Similarly, if open interest declines while prices rise, the uptrend may be losing strength. Direct hit. Part 9. Lesson summary. Speaking head in silhouette. Let's quickly recap what we learned in Lesson 7. White heavy check mark, volume measures market activity and participation. White heavy check mark, rising volume confirms the trend's strength. White heavy check mark, falling volume warns of weakening momentum. White heavy check mark, open interest shows the total number of active contracts. White heavy check mark, increasing OI means new positions are being added, strong trend. White heavy check mark, decreasing OI means positions are being closed, possible reversal. White heavy check mark, combining volume plus open interest gives a clearer picture of market strength. Direct hit. Conclusion. Speaking head in silhouette. Volume and open interest act as the heartbeat of the market. They show the energy behind every price move. Remember, price tells you what is happening, but volume and open interest tell you how strong that move really is. In the next lesson, we'll study moving averages, one of the most popular and powerful tools in technical analysis, to identify and follow market trends. Here's the Lesson 8 Moving Averages Summary from Technical Analysis of the Financial Markets by John J. Murphy. Microphone. Lesson 8 Moving Averages, Script Format. Speaking head in silhouette. Hello friends. Welcome to Lesson 8 of Technical Analysis of the Financial Markets by John J. Murphy. In the previous lesson, we studied volume and open interest, the heartbeat of market strength. Now we move to one of the most important and widely used tools in technical analysis. Moving averages. Moving averages help traders identify trends, smooth out price noise, and generate buy-sell signals. Let's dive in. Direct hit part 1. What is a moving average? Speaking head in silhouette. A moving average, MA, is a line on the chart that shows the average price of a market over a selected period of time. It moves because with every new price bar, the oldest data point is dropped and the newest one is added, keeping the average continuously updated. In simple words, it tells us the direction of the trend, whether the market is going up, down, or sideways. Chart with upward trend part 2. Purpose of moving averages. Speaking head in silhouette. Markets are full of short-term ups and downs, or what we call noise. A moving average smooths out these random fluctuations so we can see the underlying trend more clearly. White right pointing backhand index. When prices are above the moving average, the trend is generally up. White right pointing backhand index. When prices are below the moving average, the trend is generally down. Bar chart part 3. Types of moving averages. Speaking head in silhouette. John Murphy explains two main types of moving averages. A. Simple moving average, SMA. Speaking head in silhouette. It's the most common type. You add up the closing prices for a certain number of periods, say 10 days or 50 days, and divide by that number. Each day has equal weight in the calculation. Example. A 10-day SMA adds the last 10 closing prices and divides by 10. Large blue circle. B. Exponential moving average, EMA. Speaking head in silhouette. EMA gives more weight to recent prices and less to older ones. That means it reacts faster to price changes. Traders prefer EMAs when they want quick signals, especially in fast-moving markets. Tier of calendar part 4. Common moving average periods. Speaking head in silhouette. Different traders use different time frames. Short-term, 10-day or 20-day mass. Medium-term, 50-day mass. Long-term, 100-day or 200-day mass. Tip. The 200-day MA is one of the most watched indicators worldwide. When prices are above it, markets are considered bullish, below it, bearish. Chart with downward trend part 5. Moving average crossovers. Speaking head in silhouette. Crossovers are powerful trading signals. White right pointing backhand index. Bullish crossover. When a short-term MA crosses above a long-term MA, it signals a potential uptrend, a buy signal. White right pointing backhand index. Bearish crossover. When a short-term MA crosses below a long-term MA, it signals a possible downtrend, a sell signal. Example. The 50-day MA crossing above the 200-day MA is called a golden cross, bullish. The 50-day MA crossing below the 200-day MA is called a death cross, bearish. Bar chart part 6. Moving averages as support and resistance. Speaking head in silhouette. Moving averages often act as dynamic support and resistance levels. In an uptrend, prices may bounce off the MA line, acting as support. In a downtrend, prices may fall back from the MA line, acting as resistance. Traders watch these levels to plan entry and exit points. Gear part 7. Advantages and limitations. Speaking head in silhouette. White heavy check mark. Advantages. Easy to use and understand. Clearly shows trend direction. Reduces short-term noise. Cross mark. Limitations. It's a lagging indicator. It reacts after prices move. Gives false signals during sideways or choppy markets. That's why moving averages work best when the market is trending, not range-bound. Chart with downward trend part 8. Combining moving averages with other indicators. Speaking head in silhouette. Moving averages become even more effective when combined with other tools, like volume, momentum indicators, or price patterns. For example, if a bullish crossover happens with increasing volume, it confirms that the uptrend is strong. Direct hit part 9. Lesson summary. Speaking head in silhouette. Let's quickly recap lesson 8. White heavy check mark. A moving average shows the average price over time and smooths out fluctuations. White heavy check mark. SMA gives equal weight to all prices. White heavy check mark. EMA gives more weight to recent prices, faster response. White heavy check mark. Crossovers provide buy-sell signals. White heavy check mark Mars can act as support and resistance levels. White heavy check mark they lag behind price and may give false signals in sideways markets. Direct hit conclusion. Speaking head in silhouette. Moving averages are the foundation of trend following systems. They don't predict, they confirm. Remember this golden rule. White right pointing backhand index trade in the direction of the moving average. When you combine moving averages with volume, momentum, and price patterns, you get a complete and powerful picture of the market trend. In the next lesson, we'll learn about oscillators and momentum indicators, tools that help traders identify overbought and oversold conditions.